Hey, what's up? It's Ben here. If you're looking for safe dividend stocks to buy and hold forever, I got you. I've taken everything into consideration when picking these stocks, from its ability to grow in the future to whether it'll stay afloat during tough times. And I narrowed it down to 5 of them. Of course, when choosing stocks, please always do your own research first and don't just go based off of what I'm saying. And if you're just looking for dividend stocks, you might also want to consider looking at a stock's dividend safety score first before investing. And then you'll be able to tell if a stock will be cutting their dividends in the future. And of course, if I'm investing in dividend stocks, I don't want them to be cutting their dividends anytime soon. So I like seeing a high dividend safety score. And if you want to know how to get any US stocks dividend safety score, I have a video to show you how for free. Link is down below. People usually pay hundreds of dollars for the score itself. So if you want to save some money on there, go check that out, because you already know I'm all about saving that money, making that money, and investing it. So let's check out these 5 safe dividend stocks. So the first stock I want to talk about is Apple, ticker symbol AAPL. And if you didn't know already, this company has been making cell phones, computers, and other electronic devices. And this company has been growing every single year, and they hoard a lot of cash too. So that's why they're able to pay a dividend, but not too much. So this past 1 year it has grown 94%. This past 5 years, 310%. And in 10 years, 957%. And the ratings here is bullish from Wall Street, giving it a 3.94, and its price target is at $122. So currently it's trading at $116. But what's unique about this, or what's good about this, is that its dividend safety score is at a 99. So basically, if you have a dividend safety score, anything that's above a 60, you're in the greens, basically saying that it's unlikely that a company or the stock is going to cut its dividend. Its growth score is at 98. Dividend yield is at 0.7%. This is relatively low because it's still growing. The company still has room to grow. It's a tech stock. And the dividend growth streak has been paying for over at least 5 years. Its payout ratio is 24%, which is really good. Basically, what it's saying that whatever this company is earning, about 24% of it is going out to the investors, and it has still room to grow. So basically, they use the excess amount of cash to just grow the company if they wanted to. 5 years dividend growth, 10%. Return on equity 69%, and its current ratio is 1.5. So basically what a current ratio is that anything above a 1 is considered good. That's just your current asset divided by your current liabilities. So they're able to pay off any of their liability or their short-term debts within that 1 year, and which is really good. So the second stock I want to talk about is Costco, ticker symbol COST. And if you don't know what a Costco is, it's basically like a Walmart, but a better version of it. They do charge a membership fee to get in, and they have bulk discounts for memberships, and they have $5 rotisserie chicken and $1.50 for hot dogs and drinks, which is pretty cheap. And but besides that, the company has been growing. So within this 1 year, 25%. It's these past 5 years, 143%, and the past 10 years, 494%. And they do pay a dividend, which is relatively low, but it's still because this company still has room to grow. And the short interest is only 0.72%, so not a lot of people are shorting this. And the rating here, it's bullish. Wall Street's rating in a 4.0, and its price target is $371. So currently it's trading at $377. I would prefer holding it for a while, not purchasing yet, unless it pulls back a little bit more. But if you're buying for the long run, it doesn't really matter, because this company is going to grow even more because they're looking to expand to more countries and stuff. Currently it's mainly in the United States, but they do have warehouses outside of the United States as well. And if you look at its dividend safety score, it's a 99, so which is really high and which is really good. Growth score is at an 83. Dividend yield 0.74%, which is on the low end, but you have to think about this, that you can still grow too. Dividend growth streak, they have been paying their dividends for at least 10 years now. Payout ratio is at 29%, which is good. The 5-year dividend growth, 12%. Return on equity 23, and its current ratio is 1.1. It's not going to be super high because at the end it's like almost like retail. So the next three stocks I'm going to talk about are going to be dividend kings, and they're pretty stables because they have been paying their dividend out at least 50 years and increasing it as well. So the third one on this list is going to be Johnson & Johnson, ticker symbol JNJ. This company has a range of products in the healthcare field, so basically anything from band-aids to lotions to medical devices to medicine, they do it all. This company has been steadily growing. It's not growing like tremendously like those tech stocks out there, but within 1 year, this past 1 year, at 12% growth. This past 5 years, 47%. 10 years, 124%. Not a lot of people shorting this because, you know, this company has been long for at least 50 years, and they're paying dividends too as well. If you take a look at the ratings right over here, a Wall Street rating is bullish. It gives it a 4.05, and its price target is at $164.73, and currently is trading at $143.93. So right now you can think about it and whether it's going to be a long-term position in your portfolio or not. And if you check out their dividend safety score, it's 99, which is really good. Its growth score is 89, and its dividend yield is at 2.81%. And this is better than the last two stocks that I mentioned because this company has been paying out for more than 50 years in dividends, so which is really good. And if you look at the payout ratio is at 48%, which is still good. 5-year dividend growth is at 6%, return on equity is at 24%, and its current ratio is at 1.3. The fourth stock I want to talk about is Coca-Cola, ticker symbol KO. This company is a beverage company, and besides Coca-Cola, it has a lot of different other products too. You might have consumed or drank some of their products without even knowing it's owned by Coca-Cola. Their 1 year mark right here has been down by 7%, which is because of the Rona. Not a lot of people are buying brand name products if they're not making a lot of money. And the 5-year mark has been 18%, and the past 10 year has been 62%. And not a lot of people are shorting this. Is at 0.5% or 0.5%. If you look at the ratings here on Wall Street, it's bullish. We're giving it at a 4.28, and the price target is at $54.62. So right now it's trading around $50. So I don't expect Coca-Cola to go out of business anytime soon because they're the market leaders. Their dividend safety score is at an 80. A growth score is at 47. This is relatively low because I don't see Coca-Cola going to be growing as quick as something like Apple because they're already saturated. They're market leaders in their industry. Right now, dividend yield is at 3.28%, which is really good, and they have been paying out their dividends at least 50 years again, and they have increasing it too. So this coming next year or so, they're going to increase their dividend as well once again. Their payout ratio is at 84%. It's a little bit on the high end side, but I'm hoping that they could drop this down to something around 70%, but it's not the end of the world because this is not a growth company. This company has been paying their dividends for a long time now, and as you can see the chart, they don't grow like crazy like Apple or some other tech company. Their 5-year dividend growth is 4%, their return on equity is 46%, and the current ratio is at 1.1%. So again, anything above a 1 is good for the current ratio. So lastly, the fifth company I want to talk about is 3M, ticker symbol MMM. And if you don't know about this company, they basically make adhesive products, and they're well known for Post-it. And basically, besides Post-it, they make a lot of other products too. So anything from tools, equipment, and also office supplies and such. So this company has, for the last 1 year, it has grown 1.95%. It's not much. The past 5 years, 12.92%. And the past 10 years, 86.82%. It's not much growth, but there are upsides to it. They have a dividend yield of 3.48%, and its short interest is less than 1%, so not a lot of people are shorting it. So again, let's check out the ratings right now. The ratings are neutral, so analyst gives it a 3.11. Price target is at a $177, and right now it's currently trading at $169. And its dividend safety score is at 75, and its growth score is at 81. Dividend yield again 3.48%, and the payout ratio is at 69%. Its 5-year dividend growth is at 7%, and its return on equity is at 48%. But they do have a high current ratio is at 1.9. Overall, these stocks have gone through tough economic times. They either have a boatload of cash on hand or market leaders in the industry, so you can't expect them to be still paying their dividends in the future. I know Apple and Costco have a low dividend yield right now, but they have more potential to grow in the future. Plus, compared to other stocks, they have a relatively low payout ratio. What you don't get in dividends, its equity will compensate for it, and hopefully it'll be more in the future. Anyway, hope you found this intuitive. If you like this, feel free to give it a like and maybe consider subscribing for more stocks and investing related videos. I'll catch y'all later.